Hey everyone, Michael Rosmer here with Richucation. Welcome to the first day of our 5-day investment series. Now this is going to give you the foundation that you need as any person coming in to know whether you're ready to invest, what stage of investment you're at, therefore what you should be looking at, and then understanding the foundational components of investing. What's the big deal with investing? Well, basically, if you want to create long-term freedom, you got to learn to invest. Because even though you might do things that they're highly leveraged forms of work, for example, maybe you're writing, maybe you're hiring somebody, maybe you're getting some sort of residual sales commission, all of those sorts of things eventually go down, all right? And what that means is they don't really buy you freedom. They can buy you temporary freedom, but if we're talking about longevity and wealth, that really comes from ownership of assets, which is really about investing, right? So it's about being able to put your money in and have your money grow faster than it's decreasing in value so that it returns you more than you put in. Does that happen? And this happens without you doing any work in the process, right? That's really kind of the distinction between working or earning income in any shape or form and investing, okay? Now, does that work in practice? I mean, does it continue to produce more and more income over time? Not entirely. The reality is that given sufficient periods of time, I mean, the Empire of Rome fell, right? But it's much, much more enduring than, say, I don't know, getting some sort of a residual sales commission in most cases. And yes, you can invest your time. You don't necessarily have to invest your money, right? There are different ways of getting that ownership. But when we're talking about investing, we're specifically talking about investing our money. Now, this is going to be the main thing for a lot of people, not everyone, but a lot of people, that helps them to achieve freedom. And for me, that's a really big deal, right? I'm really big into saying, okay, let's try and create freedom for people so that they can do what it is that they love. What is it that's going to fuel your dreams? What is it that's going to fuel the change you want to see in the world? And investment is a big part of that. And in fact, if you really want to go and have a big impact beyond yourself, you want to learn to invest. You want to be able to spend money to make money, right? And the reason why that's so important is because money has this scalability that your time doesn't, okay? So in order to get into discussing this, we're going to talk about some fundamental pieces before we get going on any of the details of, what to invest in, etc., which is laying the foundation for investing. Because I have people come to me all the time who will say things like, should I put my money in an RRSP or a 401k? Should I be buying some sort of a life insurance policy? And all these things are good, but they come at a particular stage of the game. Does that make sense? And the reason for this is because what we want is we want the highest risk-weighted return, okay? I'm going to tell you a story to explain this principle to you, which has to do with my brother. My parents, we were very fortunate. They created university savings accounts for us. So I think my grandmother put in, $5,000 when we were born, and it would grow, and my parents would manage it, etc. Well, unfortunately, my youngest brother happened to need to take his education money out in March 2009. This is the absolute worst time of the market. Okay, basically the market had just gone way up and then way down. It went from over 14,000 points to 7,000 points. That's the Dow Jones. That's cut in half, right? So it then proceeded over the next few years to go back up over 14,000 points again. And so it was really bad timing. You don't want to be caught in that situation. And this is a fundamental piece of investing, is about planning your financial needs, okay? So I'm going to draw a little picture for you to kind of explain how this works, all right? Now, all of the best investments that you're going to do, their performance, their value, because what happens is you put money in, okay? So let's say you put in $100,000. You want that value to grow over time, okay? Now, in practice, the best ones aren't going to grow like this, okay? The way they're going to grow is they're going to grow more like this, okay? Now, if that's the case, okay, you don't want to be caught. In fact, it could have grown like this. You see where it's actually lower than when you started? So if you're going to need money, you don't want to have to sell here. If you can afford to wait until here, you're going to do much better. And it's just a big deal in investing that a lot of investing is, yes, what to invest in, but it's also when to buy and when to sell. Okay? And we're going to discuss all those topics. You don't have to worry about it. We're going to explain it. But the important thing to note right now is that you don't want to be forced to sell when it's down. Okay? Now, in order to not be forced to sell, how's that going to look? Well, just imagine this. You have certain cash needs in your life. Okay? So hopefully you're earning more than you're making, spending. And if you aren't, definitely check out the Richucation website. We've got lots of resources. Come to us, join the action classes, get involved in the community, watch a lot of the free videos, follow our YouTube channel, all these things. We got tons of resources to help you make a lot more money. Okay, so there's no excuse given time that you can't go out and make a lot more money than you're spending. Okay? But once you reach that point, okay, let's say you're putting aside $500 a month. Okay, not a lot of money, but you're getting ahead every month. And you say, okay, I'm going to go and I'm going to buy some mutual funds. Let's say that it is, I don't know, the fall of 2008 or something like that, or the summer of 2008. Horrible time. Horrible, horrible time. Not a big deal, because again, if given time, there's dividends, things are going to pay out. But what if you have a sudden emergency in March 2009, and suddenly you really need that money? Well, it's now worth half what you put in. So you put in your, let's say, $6,000, so $500 a month times 12 months, and that was your savings. Now you have $3,000 to pull out instead of $6,000. Okay? So being forced to sell is never ideal. You should be able to choose the time that you sell, but at least you want to have the flexibility to sell at a good time. Okay? And if you don't do certain things in advance, you won't be able to do that. And that's what we're mainly going to talk about in this particular video, okay? Is laying that foundation, figuring out, okay, where am I in the sequence, and doing something about it, all right? So step one, as I mentioned, is you got to be making more than you're spending. If you're not making more than you're spending, just forget about investing and go and focus your energy on making more money and spending less, okay? Because you got to have some savings that are coming in every month. And you should have some sort of a savings plan, some sort of a savings budget. Assuming you are there, all right, what's the next thing you want to do? The next thing you want to do is you want to go and pay off your debts. And by this I mean consumer debts, okay? Your mortgage is somewhat different. What do I mean by consumer debt? Basically any debt that has an interest rate over 7% a year. 7, 8%, somewhere in there. How come I say that? How come, not your mortgage at 3 or 5 or whatever, whenever you watch this video, who knows what mortgage rates will be. But as I'm sitting there recording this, they're about 3%, or at least where I am there. Here's the thing. In general, the market performs at around that 7% mark, okay? It's not that you can very easily get a very safe 5% rate of return, okay? That's not a challenging return to get, and we'll go over how to do that later on. But it's a very easy number to get. But if you were paying interest at 7% and you're getting 5%, you're losing 2%, okay? Now, on top of that, the 5% has some risk to it, not a ton. When you pay off the 7 or 8 or 12 or 24% interest, that is zero risk, okay? That's 100% risk-free return that you're getting on your money. Second of all, that money is available for you if you need it in the future. Okay, so if I'm paying down my debts, then usually I'm paying it off at a revolving line of credit or a credit card or something like that, and that's going to free up my ability to borrow more money if I need it. And so again, remember we're talking about we want to be prepared for if things go badly. Ideally, we don't want to have to sell our investments, so if we have a line of credit we can tap into, better, right? That's how come we're saying, okay, the first step first, do not worry about life insurance. And by that I mean whole life insurance, dividend participating whole life insurance policies, which we'll talk about again later. Very valuable, but comes after you've paid off your debt. Should you go and buy a house? Generally not until you've paid off your debt. Consumer debt again. Should you go and, buy some sort of mutual fund, whether in a tax sheltered vehicle or not? Not until you've paid off your debt. That first step is take a look right now where you're at, and all those savings you've got, be putting them towards accelerated debt payment. Okay? Now, if you have lower interest debt, which you might have a line of credit at 5% or 6%. 6%, is kind of iffy. Like the 7% number I'm giving you, it's a ballpark number, right? At some point in time, you might reach the stage where you can get really great rates of return. Right now, you're probably not there. If that was the case, maybe it was worth it for you to borrow money at 6 or 7 or 8%, okay? But generally speaking, if you're in that range, pay off those, what I call consumer debts, which is pretty much any type of debt aside from a collateralized life insurance policy, or it could be in some rare instances, a very low interest line of credit. And the third instance is in terms of your mortgage, okay? So you pay off the debt. Now what? Are you ready to invest? No, you're not. How come? Again, now you've got a little bit more flexibility, right? You have some credit to tap into if you go down here. So you can say, all right, but you really don't want to tap into credit. Why? Because the moment you do that, it's going to start costing you again at that 7, 8, 10, 12, 24%, right? Which is better. The whole reason here, we're just thinking, okay, how do I maximize the return on my money? So how do I get the most back for every dollar I put in, okay? And if the cost of borrowing money is greater than I can make on my investments, then I'm losing out, okay? So I don't want to ever be in a position where I have to have, say, credit card debt and not pay it off, okay? So I'm a big fan of credit cards. I use them all the time. You can collect points. It's a great way of basically saving a couple percent, but you don't want to use that to finance emergencies, gifts, etc. All right? So ideally you want to be paying it off every month. So how do you get around that? Well, this is where you create a reserve fund, okay? If you do not have a reserve fund, and this is the question that I'll ask people, somebody will come to me and they'll say, okay, should I be investing in this? I said, well, first of all, do you have any consumer debt? Let's say they say no. Next question is, okay, do you have a reserve fund? How much should your reserve fund be? A minimum 3 months expenses, okay? And we have other videos where we talk about the importance of really figuring out what your real expenses are, because generally speaking, what I see is that people's real expenses are somewhere between 20 and 50% higher than they think they are. So I'll talk to people and they'll say, oh, my expenses are $3,000 a month or $5,000 a month. But they haven't accounted for things like the capital cost of their vehicle, the capital cost of their furniture, major maintenance on their house. I have coming up on my house, I know I have to get the roof changed. I know that in a few years I'm going to have to replace furnaces. If I'm not budgeting into that timeline, those expenses and breaking them down monthly, then I'm not having a real budgetary level, okay? And again, we have videos on that, so you can go and watch them somewhere else. But figure out very thoroughly, go and watch the other Richucation videos, and figure out thoroughly what your budget is, or what your expenses are on a monthly basis, okay? And if you want to be safe, add 50% to it. I mean, you're better safe than sorry, basically. Take a minimum of 3 months of that, okay? So I would say it's highly rare, depending on where you are, you live in the world. Let's say you're talking about living in the United States, Canada, Australia, New Zealand, UK, Western Europe, places like that. High probability you're going to spend at least $3,000 a month, so your reserve fund better be a minimum of $9,000, okay? And this is, let's say you lose your job, okay? You don't want to have to tap into selling your investments in order to do that. You don't want to have to pay for it on credit card debt. You want to have money you can tap into while you find a new job. Say your business has a downturn. And by the way, this principle I would highly recommend for your business as well. Bill Gates had a policy where he wanted to be able to fund Microsoft for 12 months based on the cash they had on hand. That's a little extreme. Shareholders decided they didn't really like that. But, having numbers in and around ideally it's 6 months, okay? And so usually what I recommend is, okay, get right to 3 months, okay? Have a 3-month reserve fund. By the way, I've heard some financial planner people out there lately, they say, oh no, don't do that. You can always sell your investments. It's like, yeah, but because of this, that's why you want the reserve fund. You don't want to have a ton of money sitting in cash, and that's why we're saying 3 months, 3 to 6 months. Usually what I say is, okay, save up 3 months, then take half of the money that you're budgeting towards a reserve fund and continue to build it up to 6 months. And in the meantime, put the other half into various different investments that we're going to discuss. Okay? So that gives you the foundation of, okay, now you're ready to start investing. Okay? First of all, you make more money than you're spending, and you want to always try and increase that gap. Second of all, you paid off all your consumer debt. Third of all, you have a reserve fund. If you're in this position, you're doing pretty well. Okay, like you have a pretty solid foundation. Now what are you going to do with your money? Well, we still have this risk. Okay, so the next thing that you want to pay attention to is this is not a large amount of your money. This should not be, a huge amount of your net worth or anything. Ideally, I say kind of like 5% is a good number to throw around. But early on, because you're going to build this first, it's going to be, you're going to build up with it for a little while. And that's what we call collateralizable assets. Okay, so I'll write it here. Collateralizable. What is a collateralizable asset? Okay. Very simply, certain things you can borrow money against. Okay, now why would you want to do that? Because of the fact that what it allows you to do, usually, first of all, anytime you borrow money against something, let's say that I just go out and let's say credit cards, okay? A credit card interest rate is higher than a car loan interest rate, typically, which is higher in turn than a mortgage. How come? Well, the reason is risk, all right? So a bank knows that worst case scenario, that house is a very hard asset that generally doesn't decrease in value. It generally, over the long term, it has solid value, okay? And so worst case scenario, they can take the house back and recoup their money, all right? And they've built in a margin of safety, usually about 20%, especially if you factor in mortgage insurance. Whereas a car, also a hard asset, right? So they still have something they can take back to protect their investment, but a car decreases in value with time. So they have to be a little more careful, right? Versus a credit card, they have nothing to go and get. So if you default, they're screwed. That's it. It's done, okay? I really wish people would have taught me this in school, actually. This is pretty important. So, so because of that, anytime you can borrow with collateral, they're going to give you a lower interest rate, all right? Now that's going to do two things for you, okay? First of all, remember how we said, okay, things go bad here. So let's say that this is the narrative that's taking place. We're doing well, right? We're saving money, saving money, saving money. The market goes down, or say right somewhere around here, you lose your job. Okay, so the market's down a little bit, right? You lose your job, you have a sudden need of cash, which this would be normal, right? The reality is that people need cash. Generally when the economy goes down is also the time that people lose jobs, unfortunately, right? So those two things compound and hurt the people, right? You don't want it to hurt you. You want to be in a much better position than everybody else. So you lose your job here. You say, okay, well, no problems. I have my 3-month or 6-month reserve fund. And you tap into that and it carries you a ways. But at some point in time, you're still in trouble. You're like, shoot, you know what? The reality is that I need to make those ends meet, right? There's this gap between where I am and where I need to be. And I need to bring those together, okay? Well, what would you normally do here? You would normally sell your assets, okay? The problem is the assets are worth as little as they are going to be worth, okay? You're right at the bottom. So you really are losing out if you sell them right now. You could also go and borrow money through your credit cards and your lines of credit. Fortunately, you paid those off, right? But again, that's pretty expensive to do. If you have something you can collateralize, you can borrow against those assets at a lower interest rate, and so you can afford to hold those assets. You don't have to, so what this means is that the assets don't get sold. Like your house, if you mortgage it, say you had a house with no mortgage, you get a mortgage on it. Well, now all of a sudden, you can wait for it to come back in value while paying a low interest rate, okay? So that's what you're achieving here by having collateralizable assets. Now, there's really only two types of collateralizable assets, okay? There is a house, and there is dividend participating whole life insurance policies. Now, there are other types of life insurance policies. There's universal life, and there's various different hybrid forms of life insurance. Some are not dividend participating. The one that you want is dividend participating whole life. Why? People will say, well, buy universal life or buy term and invest the difference. That's kind of this philosophy. Again, what we like about whole life insurance policies is they're contractually guaranteed. So it's basically the most stable, safe asset that you can possibly get. It's right up there with government bonds, like AAA rated right from the government backed. It's phenomenally stable, okay? And the return is guaranteed as well. It's tax sheltered, which is something that you can't say for, as an example, if you were to go and buy a mutual fund, right? It's not tax sheltered. It's also creditor protected, so in the event that you get sued or something like that, you're protected. And you're in a position where if anything happens, you can borrow against it without needing to qualify up to the cash. There's a lot of technicality that I'm not going to go into, but the point is you can borrow against it up to a certain amount without having to qualify, which is a big deal because, again, if things have gone down here, what's the chances that you're going to qualify? You might not, right? And without the obligation to repay. So if things are really bad, you can maintain your position for a long time, which is fantastic. So dividend participating whole life insurance policies, and there's different ways you can structure them and lots of nuances. You can contact us for that. If you're at that stage, please reach out to us. We're happy to put you in touch with some really great people on the subject, help you to navigate those waters a little bit, okay? An alternative way is a house. Now, a few caveats about a house. When you buy a house, we're not talking, well, it could be an investment property, but generally we're talking about your principal residence, okay? Now, should you buy a principal residence? Now, there's a whole argument you can go into on this, and it really depends on the numbers whether this is a good investment or not, okay? The way you want to look at buying a house, there's two things that it's going to do for you if you do it smart, all right? Number one is you can buy a house for less than it's worth, all right? So, as an example, you go and buy a property worth $330,000 for $300,000, okay? Now, if you do that, the day you bought it, you instantly made $30,000. Your net worth increased by $30,000, okay? Do you follow that? So basically, you paid $300,000 for something worth $330,000. Your net worth is based on what you own, not what you paid. And so your net worth has increased just the day that you bought it by $30,000. That's pretty cool, right? Pretty amazing. Now, as I was saying, you increased your net worth by $30,000 in that example. So that's the first advantage of buying a property. Now, what's the problem? You can actually do the opposite as well. You could go and buy a property worth $300,000 and you could pay $330,000 for it, all right? So you have to really know the market, and that's where buying real estate smart comes in. And again, if you want assistance with that, we've got all kinds of material to help you do it well, okay? The cool thing about real estate, which you can't do in stocks most of the time, you can't do in life insurance, you can't do in bonds most of the time, etc., is literally the day you buy, you can increase your net worth. The second mistake that people make, in addition to not buying for less than it's worth, or not buying for, not less than it's worth, but not buying, I guess, buying more than it's worth, right? So that could be a mistake that you make, is not buying based on cash flow. Now, when you buy a property, this should be your decision-making process, okay? If you can buy a property for less than it's worth, and you can buy so that it improves your cash flow on a monthly basis, fantastic. You're awesome, okay? How does that look? Well, if you say in order to rent a place, would have to pay, let's call it $2,000 a month, but by buying, your monthly expense goes down to $1,800 or $1,500 a month, you're actually increasing your income, the amount of money that you keep in your pocket every month, by $200 or $500 or whatever the number is per month, okay? So the mistake that people make in buying houses or buying property, a condo, etc., is they increase their living expenses, okay? If you increase your living expenses, that's not useful. That's not what you want to do here, okay? At this stage, there is a place where negative cash flow properties can be effective in an investment strategy. That's not where you are at, okay? Where you are at, you want to buy for less than it's worth, and you want to buy so that you have more money in your pocket every month. And think about how fantastic that is. You could literally, like here's an example. Okay, I get to the point where I've got my savings, okay? I've saved up my reserve fund. Maybe I'm saving up for a house, okay? So I continue to put my money aside, I'm building up this cash pool, and finally I go and I say, okay, great, I'm ready to buy a house. I could go and buy a house and, first of all, decrease or increase my net worth immediately. So right off the bat, I've made money. Now, you probably won't realize that money, or not much of it, because of the high fees in real estate, but that's a whole other conversation. The point is your net worth has gone up, which has a ton of different advantages for you. Number two, you instantly increased your cash flow every month by, say, $500 a month. Well, what does that do? That $500 a month can now pay for your dividend participating whole life insurance policy, right? And so basically by buying that property, the dividend participating whole life insurance policy is free. That's pretty cool, right? I mean, that's amazing. So that's the foundation. That's where we're going to start for day one, all right, is what's your first exercise? Figure out where you're at. Figure out exactly how much you're really spending and really making. Make sure there's a differential there. Figure out how much you're saving every month and be really accurate about this, okay? And you should monitor it regularly. Money follows mastery, okay? So if you're not mastering your finances, you're not going to have money. It's just the way things go. You want to work on it every single day if you really want to achieve great financial success and financial freedom. It's not something that's hard. It's something that you can learn and get, really phenomenal results for relatively little effort. But it takes some learning. It takes some mastery, okay? Once you've figured that out, say, okay, do I have any consumer debt? If you do, pay it off. If you don't, awesome, do you have a reserve fund? If you have a reserve fund, awesome. If not, get a reserve fund. Okay, so all that savings, you're going to set it aside. And by the way, I should mention this. Your reserve fund, you never touch. You don't use it for buying Christmas presents. You never touch it. The money sits there in the case there is an emergency. The only time you're ever going to use it is so when things are bad, and you say, okay, if I didn't use the reserve fund, I would have to use credit cards. I would have to, something like that, right? You do not go and tap into this. It's not an extra pool of money. Get an extra bank account and just sit it there. Get cash and sit it into the closet. I don't know, whatever it takes for you, set that money aside, okay? If you've got all those things in place, now the thing you want to start doing is you're going to start saving up, okay? And ideally, you're saving up for a house, okay? Now, depending on where you live, it might make a lot more sense to rent than to buy, okay? It also depends, how close you are, etc. I would highly recommend that at this stage of your financial journey, you not focus on, the fancy living downtown, whatever, in this metropolitan, like living in Manhattan as an example. You know what? Live a little further out, save a little bit of money, do the math, figure out, whether it makes sense, etc. Don't go and spend, 3 hours commuting in order to save yourself $500 a month. It's not worth it. But ideally, focus on, okay, right now we're doing a short term. We're going to short term be saving more money so that we're going to live better long term. That's really what this is all about. Okay, investing is about putting aside today for tomorrow. The expression that I think Warren Buffett has is he says, somebody is able to lay under the shade of a tree today because somebody else planted one 20 years ago. That's what this is all about, okay? So ideally, looking for a property. And so basically that money, it means that you're going to have what looks like your reserve fund is going to go way, way up, right? All this cash. You're going to be shopping, and during this time you're going to be learning about real estate. Not a lot, just enough to get, that the moment you buy, your net worth increases, and two, that your cash flow improves. Now, a quick note about that cash flow improving thing. Very often the way you do that is by having somebody else rent your place. Okay, and I don't mean that as you don't live there. I mean you live there and you have somebody else. It's much, much harder to have a single person pay for a property profitably than it is to say, okay, I'm going to buy a place that's a little larger, maybe a few more bedrooms, maybe not so much square footage or maybe not so much whatever, but by doing that I'm going to subsidize it, okay, and I'm going to have at the end of the month $500, say, I would target that as a number, okay, $500 more than you would have had if you didn't have that property, if you were just purely renting, okay. At that point in time, that's going to allow you to take that extra $500 and buy a dividend participating whole life insurance policy. I wouldn't put more than, the way that I would budget it out is your target number for the dividend participating whole life insurance policy is the cash value should pay for a new car for you over the lifetime of whatever that car is. So let's say you buy a new vehicle every 5 years, okay? Let's say it costs you $15,000. you want the cash value of that policy to equal $15,000 in 5 years. And that's kind of how you want to budget. Now, again, complex subject, both real estate and dividend participating whole life insurance policies, but the point is, get those two things in place because they're collateralizable assets. If you have these things in place, you're going to be so far ahead down the road. Okay, you're going to have this enormous advantage, which actually, one last thing, remember when we were talking about buying that property for $300,000 that was worth $330,000? Now, if we ever need it, if we're ever down here, we can collateralize that other $30,000, probably borrow 80% of the value of it, and so we can take out $24,000 of it for that emergency that we wouldn't have otherwise been able to do. It also means that in case the value of the property drops, we have a margin of safety. It has to drop from 330 to 300 just for us to be at break even. Okay. And obviously, if you're going to be moving a lot, then buying property doesn't make as much sense. So go into just the collateralizable dividend participating whole life insurance policy. Okay, that's kind of how you're starting up now. Now that you're going to have that in place, and maybe you've already got that stuff in place, if you do, fantastic. We're going to go into, in the next videos, discussing the different types of assets and how they work. We're going to get into the details of how to protect yourself from the downside. I'm going to tell you some stories about people who have lost all their money thinking they were doing something well and they didn't. And we're going to teach you how to protect yourself so that doesn't happen to you. Go check out our different services, etc. We've got some really detailed training for you available with respect to this kind of stuff because, like I said, I'm covering for you the high level. I'm going to give you that blueprint. But if you really want to get massive results, first of all, I'm going to say you're going to have to do some learning beyond this. You're just not going to cover it in 5 days. Second of all, you're going to really have to get in and learn a lot about how to apply it, okay? And that's going to take, first of all, some learning, which we have some great courses for you, so go and check that out. It's very inexpensive, one-time fee that covers an enormous amount of stuff. Or the real value is joining the action classes. When you join the action classes, you get, first of all, feedback where we can run through any investment with you and take a look and show you how we look at it using all these different principles. You can also follow what it is that we're doing in real time and mirror it if you want. So we'll see you tomorrow on the next video. We'll talk to you soon.